Hey, welcome everybody. This is Kurt Brown. I'm joined today in the room by Josh Flade and by a new special guest, Tim Holland, who I'm going to introduce in just a second. We're going to excuse Monica today. We know that she's out on the road and is busy and is not going to be involved in today's call, but we'll have her back on the next call, I'm sure. Really appreciate everybody taking a few minutes out of their schedule. This is really a good opportunity for us. We hope it's helpful for you. I see a lot of people filing into the Zoom room here, a lot of familiar names and people around the country, and really appreciate you joining us. It allows us to disseminate a lot of information and updates sort of at once. As we always do, we'll send out a copy of the replay and a copy of these slides, so you don't need to worry about screen grabs or anything like that. You'll have all this in a compliant manner in your inbox shortly. And so this is fun for me today. So here's what I'm going to do. Tim's not going to drive yet on the slides, but I'm going to introduce him right off the top. Tim, thanks for being here, man.
Yeah.
This is awesome. An email went out last week, kind of brought a lot of our people up to speed. I know not everybody necessarily is on that distribution list and got that email. Tim and I have been friends for a long time. Tim Holland has been serving as the chief investment officer for all of Orion, of which we of course now are part of that Orion family. After a lot of cajoling and begging, we've got Tim to come across the wall and just be here with us in the OCIO group. And man, I couldn't be more happy about this. This is pretty cool. And I ran out of time this morning, but I was preparing a slide that had pictures of you.
Okay.
Embarrassing pictures of you.
Tim's
been on CNBC. He's like, I mean, this is a storied guy here. And I had a few screen grabs, but my favorite was captain of the basketball team at Drew University.
Correct. Yeah. No, D3 basketball, I like to say. D3 hoops is where 6'2" power forwards go to die. And I had a friend who ran D3 track, and his coach used to yell, "You boys better run faster because there ain't no Division 4," which I always thought was a great line. I wish I knew that line. No, I'm honored to be here with you, Kurt, you, Josh, the entire Town Square team. I'm honored that you would ask and beg and cajole for me to come over. So I'm really excited to get to know the clients and the clients' clients and help just keep pushing down the road this incredible company and culture you've built. To your point, an email did go out around my background and joining Town Square. So I won't go into too much detail, but I have been serving as CIO of Orion Advisor Solutions since September of 2020. Prior to that, I was the global investment strategist at Brinker Capital for about 3.5 years. And before that, spent about 17 years on long only equity portfolios as a portfolio manager and working on long short strategies as an analyst. So I've got about 24 years of deep capital markets experience. Before that, I worked at a New York City public relations firm that only worked with capital markets companies like Neuberger Berman, Societe Generale, Dow Jones Indices. And I mentioned that because I came to capital markets a bit late as a career, and that PR experience taught me how important communications content is, especially during periods of market distress and economic uncertainty. And that's something we've lived with the last 3 years. So I think you all built a fantastic company here, and I'm looking forward to really helping fly that flag.
I love it.
And get it out there. So thank you very much.
Tim and I were at different firms for a long time that worked together. So I was the co-manager of a large cap growth fund based out here in the West. We actually were used by Brinker and your group, and now it's fun that we're at the same firm.
Yeah, I'm really excited. And the one other point I'd make, and I know you all know this, is everything at Brinker was with room for the FA. Just like everything at Town Square, just like everything at Orion. And I just have a deep appreciation of the value that the advisor creates for the end client, and have always really enjoyed working with and for the advisor community. So I'm really looking forward to getting out there and meeting clients and just getting to know folks.
And for those of you that maybe are newer to these calls or newer to knowing about Orion and Town Square and Brinker and all these groups, serving as the chief investment officer, it's been about 65 billion in assets that you've overseen with your group. We sort of reorganized the way that we're running the Orion Investment and Town Square Investment Program. There's about 22 or 23 billion over here in our arm. And in time on these calls, we'll give a little more detail about how that works. But let's do this. Let's dive in. You're going to hear from Tim in a few minutes on some of the content he's going to cover. You obviously, a lot of you join this call on a regular basis. Josh, Deputy Chief Investment Officer over here at the firm, and Monica, the head of our fixed income program, who again we'll excuse today. But let's dive in. There's a lot going on. There are narratives and storylines working in every direction. I'm not sure if we're supposed to be afraid of inflation or recession. You can see on the screen here, there's a lot of debate. Are we going to have a soft landing? We have a hard landing in the economy. Are we going to have no landing at all, right? So let's go through and explore some of this. And this can't be totally comprehensive. We spend most of our lives absorbing this information. But I do want to share what I think of the really important, critical kind of points, right? Inflation is slowing. We're getting more data today. I don't think that's out tomorrow. Yet. Is it tomorrow?
Yeah. We can talk a little bit about
that. Okay.
Tomorrow's CPI comes out.
Yep, we've got big inflation data this week. It has been slowing. We'll kind of go through that. Earnings have also been slowing, but so far not to negative, just sort of to flat. The economy itself is slowing, but so far just a little bit. So at the moment we're in that soft landing window, but it looks like we're going into at least a mild recession, right? And by the way, the Fed wants that. Like that's on purpose, right? Jerome Powell called his shot back in the fall. You see the quote on the screen. I use it all the time. I mean, there's no easy way to do this. We have a lot of tools for juicing an economy. We don't have a lot of tools for slowing one down, right? We've got to be a little bit more blunt in how we do that. So far, it's working. So let's just go through those. We're going to rapid fire these. We see that inflation kind of peaked in the fall in the high 8s year over year. We're probably running more in here now in that 4 to 5% range on inflation. Again, we're going to get more data out on this. This is one of those things has been a great forward-looking indicator for decades. That's, manufacturing in this country. And we're really getting right down to that level now where historically we've been going into at least a mild recession, right? So when you talk to manufacturers in this country, you're really seeing that slowdown. Now, part of that is just organic demand slowing down. Another part of it is, and I don't have the slides in here right at this moment, but is the inventory builds.
Yeah.
So we've actually saw retailers stockpile a lot of inventory coming out of COVID. So that's playing into that as well. Labor market has been absolutely insane, broken, totally disconnected coming out of COVID. We've talked about that almost every single quarter. We are finally seeing just some early signs of maybe that labor market cooling off a little bit.
Yeah. And last week we got weekly jobless claims, which are above 200,000 for the first time in a while.
Yep.
And well above Wall Street expectations, and average hourly earnings, which I know you're going to get into as well from an inflation point of view, also seem to be moderating. And as we all know, the labor market's very much a backward looking indicator. It's kind of the last thing to maybe go before you go into some sort of mild recession. But to your point, it seems like we may be at that inflection.
And we're seeing some interesting, in the last week we heard from Disney. We've heard from McDonald's, and then we heard from Costco. I mean, these are real big barometers, and they're all saying the same thing. We're seeing some slowing now, like it's genuine slowing, right? Retail sales, right? We're Americans. We love to spend money. We don't spend less money than the year before, but that's kind of the behavior we're seeing right now. People sitting on their hands a little bit. And being a little bit more defensive and starting to be a little bit more cautious. We've seen this in shipping. I mean, these shipping rates are unbelievable, right? Down over 90% since that post-COVID era, all the way back to normal. And in some cases below where we were. Inventories, I kind of made a note of this, right? We all know these supply chain problems we had, coming out of COVID, where we've overcorrected. So when you look inside the inventory data at most retailers, including most Amazon retailers, they're now bloated with inventory, which should be really good in terms of pricing over the next several quarters, right? Lumber, right? Lumber is back to where it was in 04, 05. We really needed this, right? I mean, these are some of these commodities things. I'm not going to go through all of them, but we're starting to see, we see a softening in nat gas. We've seen,
For sure.
In gasoline and things like this. Even food. Food's been the stickiest in this space. Peaked after, last summer after Russia invaded Ukraine for obvious reasons, right? But, we're back here getting back to a 2-year low in global food stuff and global input prices. Now, I'm not seeing it at the grocery store yet. I'm still seeing $12 blocks of cheddar.
Yeah.
Right. But it's coming.
One of my favorite lines of all time, I know you all have been in this business for a long time. I got this early in my career, is that price always cures price.
Yeah.
Unless the government comes along or some spaceship lands and just upends the entire economy, price always cures price.
In commodities, that's the rule, right?
For
High
sure.
prices are the cure to high prices.
Supply comes online.
Yeah.
Because they're incented to produce. And then what happens? The supply hits.
Yeah.
Demand moderates and you get back to where you were.
And here's a great example. I read an article the other night showing how rare it is to have OPEC production cuts.
Yeah.
And then oil prices go lower.
Yeah.
I mean, that tells you right there, most people are voting with their feet on a global slowdown, right? I mean,
for sure.
Fertilizer prices tend to be a great leading indicator in food, and they have absolutely cratered. We have some really big farming clients up in Idaho, and they've talked to us a lot about seeing this. Josh is going to touch on this more in just a minute, but the market is really saying we basically peaked in interest rates. There might be one small hike. So interest rate and bond traders are saying we might get 25 more basis points of hikes, but we think we're basically done with the cycle. And over the next 2 years, we're really looking at rate cuts. We'll talk about that more in just a minute. Now, the fundamentals of the economy as a whole are still exceptional. And what's interesting is you turn on the television, you see a lot of hand wringing. If you were from another planet, you'd think our economy was in the dumpster. Really, the problem is the economy's been unbelievable.
Yeah.
I'm going to go through a couple slides on this, but we are finally seeing a little bit of cooling, right? Profit margins were making multi-decade highs. Now with the cost of everything going up, we're seeing a little easing. But remember, when you hear right now about profit margins coming in, it's from a very elevated level, right? We're kind of normalizing them. Here's TSA travel input. If you got on a plane in the last 6 months, you know what I'm talking about. Travel is fully back. And as a barometer of how healthy the economy is, you're seeing a lot of activity. Here's earnings, right? Bottom line on this chart, it's kind of weird to read, but if you're at the 50 level, you're flat, right? So year over year earnings right now look about flat. So you're coming off a really kind of high growth rate. Look at this. This is insane. I've shown this chart in the past, but coming out of COVID, we had an absolute explosion in corporate earnings. And this is S&P 500 earnings, real earnings, right? So you can see this slingshot effect where we basically over liquefied the economy. In retrospect, we're all going to end up agreeing we overstimulated to get through COVID, right? A lot of that went into earnings. We're going to have to normalize this. The normalization might be sideways, right? But we are probably normalizing earnings here over the next several quarters.
And I think, this is a big week for inflation data, CPI, PPI, but we're a week or 2 weeks away from a Q1 earnings season. Right, JP Morgan tends to be the kickoff on that front. So I think to your point, the Wall Street analysts are expecting earnings to be down a little bit year on year for all the reasons Kurt's already articulated. But we'll get a pretty good look at the health of corporate America and profitability starting in about 10 trading days. So that'll be
exactly.
helpful.
It's coming. Now, one of the narratives that's really negative, that's not fair, is the bloating of debt everywhere, right? And we talk about this regularly, but there are 3 borrowers in the United States: the government, the corporations, and the households, right? The government is where you're really seeing the problems in debt. You're not wholesale seeing that problem in corporate America or at the household level. So when you examine how corporations are running their balance sheet, at least on an expense like service side as a percentage of cash flow, so far, we're working on multi-decade lows here. So, of course, there's exceptions and there's problems in certain companies or certain industries. But as a whole, we are not looking at corporate America as having a real debt problem. Even in small business, right? This is Bank of America's small business clients. You can see, right, there was this bump after COVID in the amount of cash that small businesses were holding, really an elevated level. You would have thought that would go back down and more normalized. That's really not been the experience. So the small businesses that have survived are actually continue to stockpile even more cash. They're liquid and they're prepared for a slowdown here. Here's household, same thing, right? Debt to disposable income and debt to service. You can see this, this goes back to 1960 here. We're off the lows, right? So you have had a certain group of consumer have to reach and use a little bit of debt to get through this inflationary period. That could go higher, but we are really still at near cycle lows, and households look like they're ready to go into a recession. Unlike the way we were looking in 2008 when no one had any cash.
Yeah.
Everybody was levered up to the nines and not ready to deal with a recession.
No, that's a really good point where you drew that 08, 09 peak, considering how levered folks were into the worst recession since the Great Depression, and their primary asset, their house, went down in value.
Yeah.
So it was just sort of a toxic cocktail that got us what it got us. And even if we are going into some sort of mild recession, it shouldn't be anything akin to 14, 15 years ago, because you just don't have the leverage in the economy, I think, either at the household level or within the household level in terms of housing and residential real estate.
Exactly. And you haven't seen the behavior of the consumer has not been to strip the equity out of their house that we saw in prior cycles. So there's a lot of equity untapped, like a record amount. It's just not normal because people got so nervous about what happened in 08. They're not going back to that well.
Agreed.
Right. And here's this kind of showing this here. When you look at Americans, when things get difficult, we have two places where we can reach to tap some credit, right? We can go into home equity, right? Or we can go into credit cards. And you can see we haven't even blipped off the bottom in terms of people tapping their home equity, right? This topped at 55% back here in the 08 crisis. By the way, the bottom got cut off here, but here's the 08 period. Barely a blip up so far in credit card usage. So there's a lot of room for the average household to be able to reach and get credit if they need to get it, right? The banks themselves, now we're going to talk about this because this has been in the news so much lately, how banks have behaved. Banks had gotten to a point where they were lending out more money than they even took in from depositors. Well, we're in a very, very different place right now. We're working on 60, 70-year lows in terms of how much banks are lending out in relation to what we're putting in the bank. They're just being very careful about who they lend to. If you look in the loan portfolio at Bank of America, for example, right? Look at those FICOs. This is the average score in these portfolios. They've just refused to go back and lend into that subprime space. So the foundation of most bank balance sheets are in really good condition, and they've been really responsible about tier one capital and things like that. We're going to talk about that more in just a second. I do want to say you get a lot of news about tech layoffs. I see this a lot. Got to keep this into perspective. Amazon doubled their workforce in 3 years, doubled. They hired 750,000 people. So when they announced laying off 18,000 people, I mean, this is a rounding error from what they've added, right? I mean, so it's important. Microsoft added 90,000 people in 3 years. They've announced 10,000 layoffs. So yeah, we're seeing it. But in the broader picture of things, it's more almost just cleaning up their workforce than it is a real major correction in the labor market. Things that we want to be careful of. We've talked about this a lot. Office vacancies. This gets a lot of attention. One of the things that a lot of us are worried about, Josh, and I'm hoping you'll comment on this, is are we going to see a problem in the banking system, in the debt markets, because we continue to see commercial real estate vacancies go up? Maybe give us a minute on that.
Yeah, and the reality is I don't think we're going to see a systemic issue like what we saw in 08. And if you go back and you look at commercial real estate and the performance of commercial real estate through the great financial crisis, you saw about 11% decline on average across commercial real estate. When you look at CMBS, which is the market that all these loans kind of get bundled up. This is similar to mortgage-backed securities, but this is for commercial mortgage-backed securities. And when you look at that debt and how much of a buffer is baked into all of that debt, there's about a 30% buffer. Now, you look at that as somewhat of a proxy for banks, and banks typically have some type of somewhere anywhere between 30 and 40% buffer on their loans that they're lending out. And so even if we get into an environment where yes, For example, somebody owns a property and they have debt on it, and then they end up defaulting on that debt and the bank takes it over. There's enough of a cushion that I don't think it's going to impair banks' balance sheets from that perspective. So
Right.
I don't think that, yes, there's going to be pain in commercial real estate, I think, but it's a tale of many cities. It's a tale of two cities. It's a tale of many cities. Office space, there's going to be some pain, but industrials is showing up to be very resilient. Multifamily, I think, is going to continue to be resilient. There's going to be some repricing and probably a 15 to 20% correction in that space, but potentially less. But I think that I think for the most part, it's going to be pretty resilient.
Well, I was talking to one of our partners, one of our private credit partners recently, and they were talking about what you just said. It's kind of isolated into some of the retail, the commercial office space and things like that. And his point was, we've been writing down this paper and losses on this paper for a decade. Like, this is not an overnight phenomenon. We've actually been writing this stuff down slowly as we've gone. And his point is, the market's been sort of absorbing the refinancing of this paper for a long time. This is not sneaking up on anybody.
Yes, there's going to be a cliff.
Yeah,
it's gonna trickle into the markets, and there's going to be this trickling in of repricing. And then I think another component on the office space, I saw a really good chart. I probably should include it in this. There's a really good chart showing the net leasing and new properties, this is kind of common sense, but new properties built from 2015 and on is where the majority of new leasing is happening. So it comes down to, location.
Yeah.
New properties are going to do better than old properties. And so even in the office space, it's not like every single office space is going to go under.
Yeah.
And so,
well, we've seen a little bit of a reversion, right, Tim? Because you've actually seen, a lot of people think that we've probably seen the low in the vacancy and occupancy, at least somewhere around here, because a lot of businesses are starting to bring people back into the office. It's sort of like that pendulum of work from home.
Yeah.
Now there's some asterisks. San Francisco, downtown San Francisco, that could just get worse, right?
Yeah.
But by and large, countrywide, you're actually seeing more businesses starting to get some people pulled back into the office, saying, the pendulum went a little far.
For sure. And unless, God forbid, and obviously no one wants to see this, a reacceleration in the pandemic, that extreme point is gone, right? We saw it, we lived through it. And fortunately we're past it. So I agree with you 100%. And Josh's point, city by city, location is so important, because I think one of the great things about this economy of ours, this country of ours, is that capital goes where it's best treated.
Yeah.
And when people, jurisdictions, city states have to compete for the best and the brightest and have to compete for capital, I think ultimately that's good for the economy overall. And that's also why active management, I think, adds value across just about any asset class, but matters so much within real estate, because the backdrop in Austin, Texas, or in Florida is a lot different, to your point, Kurt, than San Francisco or Chicago. They're great cities, but right now, maybe not such a great downtown office market for sure.
Anecdotally, I just read last night that Whole Foods is the largest grocery store in San Francisco City. It's been open for 1 year last week, and they're closing it immediately.
Wow.
really?
Yeah, and Whole Foods said, we can't ensure the security and safety of our employees in San Francisco anymore. This is Whole Foods.
Yeah.
I mean, right? I mean,
Yeah.
That's a big deal.
That's
Yeah. So again, it is, you're right. Location.
And they're very thoughtful. Like their due diligence on when they open up one of these grocery stores is very high level.
Right.
So that's crazy.
And I don't want to make it political, but they're friendly to a lot of the agendas in San Francisco.
Yeah.
And they're pulling it back out of San Francisco. I mean, zombie firms, we've talked about this in the past. One good thing about recessions is we can come in and clean up some of the dead wood that's built up in the system. There's still a fair number of businesses operating with really stressed balance sheets. And that's why you hear us in our investment strategy team here. When we work with you, we work with your portfolios. The job number one is the preservation of capital. We just don't want to invest in businesses that are not really well run, clean balance sheets, lots of free cash flow. And sometimes you don't perform as well when you own those types of companies, but I sleep better at night. So most of you know, we talk about this on a regular basis. Okay. let's talk about the banking thing. It's a big deal. Okay,
Yeah.
I've gotten more questions on this in the past month than anything, by far. Okay, so here's the scary news, right? So you have nearly 900 billion in deposits have left in a month, have been pulled out of just traditional savings and checking accounts in this country, right? Massive, massive number. Ultimately, this right here is the problem. The Fed raises rates over a 12-month window so that now you and I can buy really short-term government bonds and get 4.5% of interest. Okay. Is your bank paying you 4.5% interest on your checking and savings account? Clearly not, right? And they've almost not even moved. They almost haven't even budged. Okay. Just that right there. Just assume that every bank is perfectly well run. That's just a business problem. I'm pulling my money out of your checking and savings account at some point, and I'm going to buy a money market fund. I'm going to buy a bunch of bonds. I'm going to find a better place, right? Your point about capital is going to go where it's treated well, right? So that in and of itself was a problem, right? But then on top of it, you had some very, very specific things with a couple of banks going on. And I love this quote from JP Morgan. Silicon Valley Bank's the first major failure I've seen where the primary issue was a duration mismatch, not a blow up in credit quality or in loans being written down, right? I mean, this is a weird problem to have. Silicon Valley Bank was raising deposits like nobody. I mean, just bringing it in. And any of us that have friends in Silicon Valley, we have a lot of them there. They know the brand there in there. Bottom line was these banks had a lot of these high risk deposits. And then all of you been reading in the news, the bank has to turn around and do something with those deposits, right? So it seems obvious and safe to buy government bonds. The problem is, as the Fed's raising rates, the prices of those bonds are going down that they bought. The bonds are safe, but they're going down in value. At some point, the bank has to sell some of those bonds and really actually accept and realize the losses. Rumor gets out, they don't have the funding they need to run their bank. $40 billion was pulled out of Silicon Valley Bank in one business day. Right? I mean, you talk about like a bank run, a good old-fashioned bank run.
It's a wonderful life.
There's lots of blame to go around, but you need to see one thing that's kind of unique here. This is from Silicon Valley Bank's own filing, right? On February 16th, no hedging. So they had all these bonds, $120 billion in bonds on their balance sheet, no hedging of any of the securities. Now, of course, they didn't hedge because they thought, oh, it's government bonds. But at the end of the day, you still have to hedge price if that's how your balance sheet is built. That's reckless. Obviously, they would do this different if they could look in the rearview mirror. But my point of bringing this up is this is really unique, right? You look at this chart where these guys were living is not where the banking industry lives, right? Let me jump ahead to something here. This is an important note, okay? So to answer the question, are we going to see a systemic problem in banking? We really firmly believe the answer is no. These were unique outliers. Okay, so number one, by and large, Goldman talked about this last week as well, but we've been watching this for years. The required amount of capital that a bank needs to have on their balance sheet, we are well in excess of that in that country. It was moved up from here to here after the financial crisis. And the banks have been operating up in here in what's the required minimum amount. Goldman, in a note last week, said, of all the banks that we cover, banks are way above their regulatory minimums, okay? But now we have to do this thing we weren't talking about, which is what if we pretend that all the banks have to mark their bonds to market, not this weird rule where they don't have to mark their bonds to market that got Silicon Valley Bank in trouble. That's this chart on the right, okay? So the blue is not marking their balance sheet to market, and the gold is. And you can see JP Morgan, Citibank, these guys are coming out bulletproof. Look where Silicon Valley Bank was. If you mark their bonds to market. I mean, this is really, really unique. They really were an outlier to this. And you can see that most banks are still really in a great position, even if right now they had to liquidate their bond portfolios in their balance sheet.
100%. And something that the Fed did when all this was unfolding was announce something called the Fed Term Bank Lending Facility, $25 billion line of credit at the Fed, which essentially said, and if was in place when Silicon Valley Bank had to sell those securities at a massive loss to meet the depositor withdrawals, they didn't have a choice, probably they'd still be in business. And what the Fed did was they said for anyone who's got a bit of depositor distress, is seeing deposits flee, has got a securities portfolio that's underwater because of what's happened with interest rates, come to the Fed. You can borrow against that paper, to use sort of the nomenclature, but we're going to value it at par, right? So we're going to assume that the bond that you're going to get $100 back for in 5 years is worth $100, not the $75 that the market's telling you it's worth today because of what the Fed has done to rates. And you can take that money, borrow against the securities at par, and then use that as you see fit, especially within meeting liquidity needs. And if the Fed had had that in place, Silicon Valley Bank would not have had to realize, I think it was high single-digit billion-dollar loss on that $21 billion sale of securities, whatever the number was. They could have just borrowed against that and met those withdrawals. And then that bank run, right? Sort of, I said, It's a Wonderful Life. You know, we've all seen that movie. It was a bank run in a digital age. Probably wouldn't have happened because folks would have realized, okay, the money's going to be there.
For sure.
And so that was a huge backstop.
And that is a riskless transaction by the Fed. It's a brilliant program by the Treasury and the Fed because it's government bonds.
Yeah.
Okay, so they have to hold them for 5 years. In the worst case scenario, they hold their own bonds for 5 years. That's like the worst thing that happens here. That's why this is not a bailout. So you hear people coming on here and hand wringing, and, you know, whatever. What do you think? I'm going to have Josh weigh in here on something because I hear a lot of people saying, "Well, is the FDIC going to run out of insurance?" Right? If the incident of the Silicon Valley banks and the signature banks of New York pick up, and we have more of these, the FDIC is going to run out of money, et cetera, et cetera. Give me your thoughts on that as well. Add to what Tim's saying.
Background: I covered banks at Goldman, and I covered banks for my last job too. So I'm pretty fluent in the banking sector, and I would say, and to Tim's point, I think that it happens so fast that the Federal Reserve and all the regulators were not quite ready to solve this solution for this problem. And if it would have happened instead of over 2 days, if it would have happened over 7 days or 10 days, I don't think that Silicon Valley Bank would have gone under. No. And I don't think Signature Bank would have gone under.
They had 120 billion in bonds. They had to sell 21 billion in them.
Yeah.
They only lost 1.5 billion.
Yeah.
But the word leaked out.
Yeah.
Right? Because they have to report that.
They reported
then all the venture funds say to all their customers, pull your money out of Silicon Valley Bank.
Yeah.
It's a new world.
Yeah.
Like,
it's crazy.
But had they not had to mark down that just the 1.5 billion, 1% of their balance sheet.
You're right.
Because they could have given those bonds to the Fed.
And you think about the communication on Friday when the announcement was, hey, Silicon Valley Bank is going under, it's going into receivership. And on Monday, all FDIC covered deposits will be available, was a communication on the Friday before that Monday.
Yeah.
On Sunday night, what did all the regulators come out and say? We're backstopping all deposits, and all deposits will be available on Monday morning.
That's right.
So there was a huge, I mean, I'm regulators are staying up all night in these
all
meetings,
weekend, man.
all weekend, meeting and talking and saying, okay, what's the worst case that could happen?
Yeah.
And I think that they knew that this was a real crisis. I mean, this could have been an 2008 kind of crisis situation.
Could have been a run, right?
Exactly. Where you could have seen a lot of regional banks going under if they had not stepped in and backstopped.
And it looks like it's really worked because for 2 weeks, we saw massive outflows from all banks, but more outflows from the small regionals.
Yeah.
But last week was net inflows into small regional banks.
And
that's a big deal.
And I think
they're 3 weeks out.
Yeah.
I mean,
I think people are taking comfort that another bank has not failed.
Well, and here's what's if we all get back together in a few years and talk about this, I think what the postmortem will be is FDIC just undercharged for their insurance for decades. Mm-hmm. I think what we'll end up looking at is, of course, all the deposits are going to be backstopped, and the banks are just going to have to pay more money to be sure they're insured.
And I actually think the FDIC is not going to take big losses on this either.
No.
I mean, they had to sell some assets at discounts, but I think at the end of the day, the FDIC is not going to see. You see these numbers. FDIC lost 15 billion, 20 billion. The reality is I don't think they're going to see that.
Especially if the collateral that they're accepting ends up being treasuries.
Yeah.
I mean, then you just have to run off the duration, and then
you just let it.
Well, it was important to talk about that because I know everybody's asking about that. And it doesn't mean there couldn't be more problems, but it is important to understand. You can see it on that chart there. Silicon Valley Bank was a very, very unique, and so was Signature Bank. These were two really unique banks.
Signature Bank, I don't think it's on.
It's not on this chart.
It's not on the chart, but it would look a lot like the other ones. So what was unique about that bank that was consistent with Silicon Valley Bank is highly concentrated
Yes.
depositor base.
Yes.
That is commercial deposits that are very flighty. And that's why.
And that's why First Republic was the next one on the list, right?
Exactly.
That's why it's in
That's a
everybody's
similar story.
crosshairs. Yeah, yeah. Most of these banks have really well diversified bases, portfolios, asset mixes, industries, et cetera. Okay, let's move on. So risk assets, investment assets are not cheap, but they're a lot more reasonable than they used to be. You look at historical context, just 25 years. This is the S&P 500 trading pretty much right at where the 25-year average is. We can't really make the case that assets are cheap, but we've gotten out of a place where they're super expensive as well. One place that might be cheap is small caps. When you look at the multiples there, small caps are not right for everybody. But if that's a place you don't have any exposure, that could be an interesting place to look. You don't get a lot of opportunities to buy these smaller emerging companies at these levels. I find this very interesting. This is the largest survey of professional fund managers in the world. It comes out monthly. It's run by Bank of America. Okay. In this last survey, what's so fascinating about this is how pessimistic even the pros have got. Why do I like that? Because historically, that has been the very time you want to be adding risk, is when even the pros are nervous. So the way to read this chart is that the number one overweighted asset in the month of March was cash. And the number one underweighted asset by these fund managers is equities. Now, I don't know if they've really done that, but that's what they're reporting that they do. So that's a bearish posture there. And I've been watching this survey for a lot of years. I don't see that very often.
Sentiment is maybe the greatest contrarian indicator of all time. When there's no one left to buy because everyone's in love with the market, there's no one left to buy. And when everyone hates stocks, there's no one left to sell.
Yeah.
Right. So yeah, you always take the other side. History tells you, knock on wood, to always take the other side of that trade.
Yeah. And
for sure.
And for me, the trader in me, started my career on the New York Stock Exchange. I've got that trading in my DNA. I start licking my chops when I see stuff like this. I want to sharpen the pencil and find what's interesting. Here's another thing that's really interesting. We've seen 2 quarters in a row with equities up over 5%. Very rare. Also, not the thing that you've ever seen in the middle of a bear market, ever, not one time. Here's another thing that's interesting. Anytime the first quarter of the year has been up over 7%, going back about 75, 80 years, the market has been up the rest of the year 100% of the time. And look at the number, like an insane data set, with the market ending up 23% on average for the year. Okay, so we have a lot of momentum here, and here's what I find so interesting. And I'm not saying we for sure bottomed in October. I suspect we did, but what's so interesting is, look what happened with Silicon Valley Bank. We spent 2 weeks thinking we might be facing a domino effect in bank collapses. S&P 500 up in this window that's insane, right? That shows you how much negativity is already been priced into these assets, right? And I'm not saying we don't go lower. I'm just saying that's the kind of thing I want to see from a market that's really getting exhausted, in the selling.
Yeah, the resiliency of equities has been pretty impressive. And I know Josh is going to talk about China, US, some of the saber rattling, and again, headlines sort of come and go, but the resiliency of the market in the face of what has been a pretty scary couple of 4 weeks for the banking system is really impressive.
Yeah, we've thrown a lot of stuff at the market this year. So
a lot of stuff.
A lot of inflation, recession, banking crisis, and we're up on the year. I mean,
Yeah.
it shows you a market that's acting pretty good. I've talked about this in the past. I just want to say, because I know a lot of you worry about the crypto market. We saw a big sell-off in Q4 last year. Here's the bottom line. As of last night, the entire value of every crypto coin in the whole world was 1.2 trillion, which is the same as the size of Berkshire Hathaway and United.
Yeah.
So it's meaningful, but it gets a lot more attention. In reality, in the global economy, it's kind of a pinprick.
Yeah. And one quick point I'd like to make about this is, if you think about Signature Bank, Josh talked about not just Silicon Valley, but Signature Bank, they were heavy in the crypto space. And I think that was part of the problem from a depositor-based perspective. If you go back to Sam Bankman-Fried, SBF, I'm going to start going by 3 initials. Yeah. Like, it just seems like you're cooler if you go by 3 initials. I know. But mine are TAH, and that just doesn't sound as good. But you had FTX implode. You had Signature Bank. You've had Binance. And again, I'm agree or disagree with sort of digital assets and what they may or may not be. I am actually pretty impressed with and comforted by that there have been these sort of landmines that the markets have stepped on in the crypto space over the last 6-12 months, and it hasn't really blown back outside of Signature Bank a little bit, broadly speaking, on capital markets. He let a lot of air out of what a lot of people would agree, I think, was this kind of digital asset bubble. And the knock-on effect, at least as far as I can tell, has been very contained. And I just think that's a big, big positive for traditional banking and the traditional capital market system, that you haven't seen this ancillary sort of follow on from a negative
I think that
perspective.
is an awesome point. It's a point I have not given enough attention to.
Yeah.
Because historically, we run into crises when those things blow up. Like SBF's blow up could have led to some real problems in the hedge fund community or other places, and it just didn't.
Yeah.
It really hasn't been a systemic problem. I think that's a really important point, Tim. Okay, I'm going to skip over a couple of things here because we've kind of covered some of these in the past. I do want to show this one as a word of caution. I do get clients asking me, Kurt, it looks like we're going into a recession. Should I move to the sidelines, wait a little bit until the all clear signal? I want to show you why I tell you no. The investment community, and I'm going to show stocks on the screen, but it's anything. It's private equity, venture, bonds, whatever it might be, is a forward-looking discipline. It's not, we don't drive out the rearview mirror. The problem is that historically the stock market has bottomed 15 months before the government finally officially said the recession was over. And in that 15 months, it's gone up an average of 61%. So you miss a lot of the new bull market if you wait for the government to look out the rearview mirror and tell you the all clear signal has been blown. So I just show that so we don't try to get too cute as we build investment portfolios. One other thing that's a big deal here, I touched on it earlier, it's owning these quality companies. I know that sounds stupid if you don't do this for a living, but there's a technical definition in the investment community for a quality company, right? A lot of free cash flow, clean balance sheets, really high returns on equity and capital and things like that. If you look over the last 40 years, and I said to you, would you rather buy value stocks, growth stocks, or just high quality companies? Well, it's not even close. We would have thought growth, right? We would have said, oh, buy all growth companies over the last 40 years. So we're big fans of owning these really high quality businesses. And again, sometimes they actually underperform. 2 years ago, they underperformed, right? But man, when it starts hitting the fan, that's the kind of assets I want to own. I just want to put in a plug for that again. I like to say it's never too late to fix what's wrong with your portfolio. So if you've got some things that are just sort of out of sorts, you don't feel comfortable about, talk to your advisor, get it right so that you own the right types of assets. I'm going to hand it over to Josh.
Okay. Let's jump in. I really like this chart, and Tim and I were talking about this chart yesterday, and just because it really highlights and puts into context 2022. 2022, if you look over here, I'll focus on this chart. If you look at the 60-40 portfolio and you look at how stocks and bonds perform together, it's very unusual. If you go back, this is what, 90 some odd years, only 4 times in that time period have you seen stocks and bonds both go down. Yeah. And this is this was quite the outlier too in those data points. You look at some of these years, right? 1931, Britain abandons a gold standard, the World War II, right? 1940. So these are like really big events going on, and how the markets react to that. So I like this because it puts it at what we experienced last year, which was tough. Anybody invested in stocks and bonds last year, it was a tough year.
Yeah, and I think it's a great slide if any of our clients still have clients that are still a bit skittish because 2022 was so hard. To Josh's point, gosh, the odds of that happening again anytime soon, knock on wood, are pretty darn low. So,
and especially not 2 years in a row,
for sure.
Right? And I think that's because if you look at bonds, what drove this was interest rates going higher, bond prices go down, and so but now. So that's the bad news. The good news is that interest rates are higher again, and I want to show this. This is the ag, and then this is the S&P 500 year-to-date performance. And I wanted to point this out because you have the S&P 500 up here, kind of the performance that we're seeing, but you're starting to see a normalization in the relationship between the two asset classes. So when interest rates when the market was doing really well, interest rates started going up and bond prices went down. But then what happened when the market really started kind of selling off? interest rates started going down, and what happened? Bond prices went up. So those correlations between those asset classes have somewhat normalized this year, which is creating, I think, a good environment, again, a normal environment for this, your typical 60-40 portfolio, which I would argue is not dead. I know there's all these conversations last year and the year before, is the 60-40 portfolio dead? I don't think it's dead. Looking at what we've seen across treasuries, we've seen a parallel shift down across the curve with a little bit up on the front. And so that's really driving some of this performance within fixed income, this kind of flight to quality trade that we've seen. Now, looking at BBB rated bonds or investment graded bonds as a proxy, you're seeing similar story, right? You're seeing yields across these bonds have kind of come down across the curve, but have actually gone up a little bit on the front of the curve in expectation for maybe a little bit more aggressive Fed in the short term. But there's definitely, some concerns in the longer run. There's a similar story in high yield, not quite to the same extent, but you've seen, the belly of the curve, yields have come down, but yields are still staying up on the front of the curve for high yield bonds. So what in the Fed is going on here? Sorry, I thought that's kind of funny.
I'm laughing. I'm laughing.
So if you look at the last
That's
two,
a bond guy. This is not bond.
Oh, yeah,
right
bond
there.
guys are really smart.
I know.
Bond guys are smarter than the stock
I
guys.
know, that's bond.
anyway, I wrote that at midnight last night. So okay, let's look at what's happened. So the Fed, in their most recent meeting here, this is all of these yellow marks here. They're projecting what they think interest rates are going to be. And if we compare that to what they were thinking in December, which is all of these numbers. So this is basically saying, hey, these two charts were the forecasts for the year end of 2023. You look at that number, they're forecasting that it's going at the end of 2023, the Fed funds rate is going to be a little bit north of 5%. And that has not changed meeting to meeting. Same thing here, meeting to meeting forecast for 2024 has not really changed much. And similar here, meeting to meeting forecast for 2025 year end has not really changed much either. But what's changed a ton is the expectation by the markets. So there's a massive disconnect between where the market is forecasting Fed funds rates at the end of this year and where the Fed is forecasting Fed funds rates. Somebody's going to be wrong and somebody's going to be right.
Yeah.
We'll see what happens.
And
I want to point that out.
No, it's a great point. And I always like to remind myself that the Fed has something like 400 economists who hold a PhD in economics on staff. So clearly a bunch of smart folks, but they don't always get it right. And so expectations around monetary policy can shift so quickly, not just on Wall Street, but at the Fed. And as Josh knows, as Kurt knows, if you go back to late 2021, coming into 2022, the Fed didn't expect much in the way of anything in terms of interest rate increases, maybe 50 basis points for the year, 100 bips, whatever the exact number was. And they did 450, which was a record for a calendar year. So if anyone says, well, the market, is completely off point here because look at the Fed, like any other institution, any other group of people that are doing the best they can, don't always get it right. And they could change their mind. And they have changed their mind for sure.
You can drive a truck through that range.
Yeah.
I'm not sure I've ever seen the scatter plot look like that.
It's pretty wild.
Yeah. And this is another just similar data kind of pointing out what's the market expecting. And so there's pricing in right now is one more hike of 25 basis points or 0.25%. But what is the market forecasting by the end of this year to a decrease of about 0.5% to the Fed funds rate?
That's
so
really incredible when you think about it. You really think about a short term, how, just such a bifurcated look.
Yeah.
I mean, everybody's basically convinced of the same trade here.
Yeah.
We got to get a little bit more inflation under control, and then we're going to start cutting to get the economy going again. Yeah. So that's what opens up the possibility for shocks, right? Like, what if we don't go into a recession?
Yeah.
Like, what if inflation doesn't slow down?
That would be a big surprise. You get a scary CPI or PPI trend for sure.
And the market's not ready for that. So that's, and we'll talk about that at the end of the summary.
Yeah, for sure. This is interesting. And Tim, do you want to maybe talk to this and about kind of what we've experienced and how this is kind of like a Fed hike without a hike?
Sure. No, I'd be happy to. So Chairman Powell at the post-March press conference said the way to think about the banking crisis directionally was as a rate hike, as a tightening of credit conditions because of the uncertainty it was creating across the system. So there are two graphs on the screen that speak to that. On the left, the St. Louis Fed Financial Stress Index. When that line goes up, it means financial conditions are tighter. And when that line goes down, it means access to credit is a bit easier. Well, it spiked when Silicon Valley Bank ran into trouble and Signature Bank did too. That line's come down a little bit. As to Josh's earlier point, we haven't seen another bank get into trouble. What's interesting though, on the right-hand side, is the Fed talks to loan officers across the country on a regular basis and essentially says, do you feel more optimistic about credit, or are you being a little more pessimistic in how you're pricing credit? And loan officers as a group are being tighter with capital. And we think that's a direct result of what happened with Silicon Valley Bank, with concerns around deposit bases and things like that. So there are lots of things that can sort of slow the economy or speed it along. And we think what's happened in the banking system is a bit of a de facto rate increase, which makes it more likely that the Fed maybe doesn't raise rates at its next meeting. It could still do it. But if this hadn't happened, I think that's an easier decision for the Fed than what they're dealing with because credit conditions have tightened for sure.
By the way, I will tell you, we have smart clients.
Yeah.
20 minutes ago, Michaela came in the Q&A and asked, wouldn't the bank scrutiny over lending be essentially like the Fed raising rates? It's going to help slow down the economy, right?
Yeah.
So we not have smart clients or what?
100%.
Good job, Michaela.
Yeah, that's great.
Yeah, and the numbers I've seen is something like a 1% hike is the equivalent of what we're seeing in this pullback by the banks.
Yeah.
And anecdotally, I've talked to a lot of people in the banking sector, and they're all saying the same thing.
Yeah.
Banks aren't lending.
Yeah.
They're all pulling back.
Yeah.
So it's pretty interesting. Well, let's jump into summaries, and then maybe we can do Q&A, or do you want to do Q&A right now? And then
why don't we touch on something real quick that I want to be sure we get to it, and that is, let's talk about the dollar. Okay, we you have to pick and choose when you're doing calls like this because there's so much right now going on. Let's talk about the dollar. But it's one of the other questions we're getting all of the time, and there's a few questions sort of inherent in the one question. One is, my whole career, 30 years, people have been asking me, the dollar is dying. It's not going to be the world's reserve currency. We're a weakening country. Our people in Washington are idiots.
Yeah.
We're printing money like there's no tomorrow. By the way, I don't disagree with any of this, what I'm saying. But what happens is we're going to be replaced as reserve currency. The other thing, though, is just simply, are we printing too much money?
Yeah.
Right? Are we de-dollarizing? You guys want to touch on that for just a minute? Because I think there's some really important points.
I'm happy to take the first step, and I don't want to come across as kind of Pollyannish or like flippant. But I think when you look at the data, and obviously, right, yes, this is really good data out of IMF talking about the foreign exchange reserves at all the different central banks around the world. And yes, the US dollar as a portion has gone down, but it still is a massive portion, right? That's telling you that all these central banks around the world are still holding a ton of US dollars. Now, some central banks, the Russian central bank, has gone away from using the US dollar for, I would argue, good reasons from their perspective, but the vast majority of banks are not going away from that. And if you look at the Chinese yuan, yes, like it is coming up on, but it's not.
It went from 0 to 3%
yeah,
of the world.
It's still not massive. And I think there's a lot of nuance to all of this, but I think that when I think, this is a really good quote, and that's why I put this in here. I don't know, Kurt, if you've seen this yet, but this is from Taleb, who he wrote Black Swan, probably one of the smartest people out there. And basically what he says here, because somebody's asking, hey, are you worried about the collapse of the dollar? And he says, you will only start worrying about the dollar status as a reserve currency when you see long lines outside of Brazil, Russia, Iranian, Chinese consulates full of young professionals seeking immigration visas. And it's true. At the end of the day, people still want to come to America, and they don't want, like, you don't see people lining up to go to Iran to get jobs. Yeah. And so that, like, the US's dominance is going to be around for a long time.
I don't talk about this a lot, but I'm going to share it. So I used to be based in China on the mainland. I still sit on advisory boards of a couple of major Chinese financial services companies to just help. When you do business in China, it's the way you do business is, we think of it as corruption and bribes, but favors are important. I do favors for you, you do favors for me. It's just sort of the way things are. It's not necessarily corrupt. It's just like, you're not doing anything illegal. It's just that you help each other out. Then I got 2 requests over the last 15 years of the 2 ways to help people out. And these are Communist Party officials. These are private corporate players in China. And I always get the same two requests of how I can help them. Can you help me get my currency into dollars? And can you help my kid get into a US university? To your point, right? Everybody we do business with over there would love to figure out how to get out of the Chinese currency and into the US dollar. I mean, when you think about this, yes, we have a lot of problems at home. We have a lot of infighting. We're that family likes to punch each other in the face. And we've got all kinds of issues. But when you look at the other options of reserve currencies, the Chinese currency, the yen, the euro, it's laughable. None of those can make a case to be the reserve currency, and certainly not crypto. So we have problems, but we are not in a position where the US, and look what happens every time. What happened the last couple of years? The dollar went through the roof. When the world's scared, where do they go? They run to treasuries, they run to dollars.
The dollar. I mean, you saw that right on the back of And Tim has some really good thoughts. You want to share, like, what are you thinking, and why would you think the U.S. would maintain its kind of dominance, even if, for example, China surpasses the U.S. in GDP on a notional level? Why would the U.S. still maintain kind of that reserve currency dominance?
And I may come across as too much of an optimist as well. And I think maybe the tricky thing in our industry is we want to be able to quantify stuff, right? What's the PE ratio? What's the internal rate of return? What's return on invested capital? And I think a lot of it, and Kurt's already touched on this, and I think Josh's, the quote that you read from Nassim Taleb was just brilliant, is this is kind of the soft stuff, the qualitative stuff. And so when people ask me about the deficit and the dollar and the country and the political construct and all that and what it all means, I kind of say, listen, we've got the world's largest, most liquid capital markets. We have a rules-based political system. It doesn't always work perfectly, but it's rules-based. We have a judicial system that people trust. Sure, it gets some stuff wrong, but people trust it. We respect property, both intellectual and physical property. We don't appropriate property. We don't tax at usury rates. We tax at reasonable rates, and we let people come and go, and capital come and go pretty much as they want to. And to your point about your colleagues in China, we have set aside maybe some of the behavior at the university level, the world's best university system by far. So until those things go away, I would never bet against this country on a relative or an absolute basis. That's kind of what I come back to. 100%. So,
can I touch on, because I know there's conversation around China, Iran, Saudi Arabia, and this broker deal by China real quick. And I think, and I also
get a lot of questions about this.
And this applies to on an individual basis. When I see people doing stuff, I kind of ask, like, okay, follow the money. Like, what? There's always an incentive for why people act the way they act, and it's the same on the macro. There's always an incentive for why on the macro people act the way they act. And if you look at the underlying data, the U.S. is not dependent on Saudi Arabia anymore for oil. So you look at U.S. usage consumption of petroleum products, and then you see what's happened, especially with technological advancements in the last couple of decades with shale and all of that. We're now producing so much energy related products.
Look at that change in production.
You look, and then you look at net imports, and we're just not having to import, relatively speaking, right? Because we just don't need to, because we're producing so much. And who does this hurt? You look at OPEC, and you look at OPEC and how much we're bringing in from OPEC over the last decade plus, and it's becoming a fraction of what it used to be.
Right. I mean, and we've talked about this for years, right? Not being dependent on the Middle East. Go back to that prior slide there. Look at that. We're pulling more of the ground. Our rate of growth is slowing. You saw that on the chart, and then we're partnering more with Canada. So we're getting the job done. Lowering our dependency on the Middle East.
Go back to 2010, and you look. This is production, or this is looking at Saudi Arabia, some data out of there, right? How much of their GDP or whatever, crude petroleum, massive amounts. But then you look at who are their big partners. The U.S. was the second biggest after Japan, 12.3%, and you look at China, 12%. But now look, China's almost doubled, right? And where's the U.S.? Only 5%. So if you follow the money, like, obviously Saudi Arabia is going to do whatever China wants to do, and they'll go along with them and say, oh yeah, China, you can broker this peace, relationship with Iran. You can we're happy to trade in the yuan, whereas I know historically we've only traded in the US dollar. Like, we're happy to do that. Why? Because you are our biggest purchaser of our product.
Yeah.
And so it's not that there's a preference globally to go to the yuan, to China. It's just, it's more circumstantial.
Yeah. Let's wrap it up. We good?
Yeah.
We're at the top of the hour. There was one topic we didn't get to, and that was the possibility of China acting hostile towards Taiwan. If anybody, we have some great articles on that. If anybody wants to do some good reading on that, we've got a couple good things. Hit us in the email. We'll send it to you. We'll save that for a different call. We're going to leave you with this slide here, sort of our summary talking points. We don't do prognostications. As you know, it's a sucker's game. We're just sort of balancing out the risks and where we're at. This is the checklist. We've gone through most of it. A great portfolio has to be built in preparation of weathering storms, because you never exactly know when the storms are going to come. That's why a great financial advisor is so critical to have and help you put that together. There is not one right way. Every family, household, corporation, etc., has unique issues and needs to invest their money sort of in a different, unique way. We're here to support that. We're here to help that. Ask your advisor. And if there's something you're worried about, definitely ask. And if something needs to be fixed, we'll get it fixed. So anyways, Tim, welcome to the team, man.
Yeah, no, couldn't be more excited. I hope I did well enough that I get invited back and I get to use the pen, because the pen's the coolest thing ever. And I was not allowed to touch the pen. I understand there's a probationary period, but no, I'm very grateful to be here. Couldn't be happier, and really looking forward to working with everyone.
All right, everybody, have a great rest of the month, and we'll see you on the next call. Thanks again for joining.